I'm on a mission to help 3,000 families with their auto home insurance so they can feel comfortable, they can feel secure, and they can feel that they can get a hold of their agent, right? Because so many people feel like, I don't know my coverages. I don't feel comfortable asking my agent, or I don't know that I can ask my agent, or they just don't, I don't know.
People don't even understand it.
Yeah. Yeah. And not that they need to understand it. People don't need to understand their coverages. Yeah. They need to trust that the professional they're working with understands and has considered all those things, right? Like most people don't know about water and sewage backup coverage. Most people don't care about that until it happens to them.
Yeah.
But they do care. Hey, my agent never brought up to me that I don't have water and sewage backup coverage.
Yeah.
They never mentioned buried utility lines coverage. They never mentioned, I'm trying to do better about this one because I don't bring up earthquake and flood, and I should. Right. Most people don't think about flood and earthquake insurance, or they come from California and they're very aware of earthquake insurance.
I think my game plan is just to get earthquake insurance once the Salt Lake Temple gets done.
Yeah. It's so true. As soon as Salt Lake Temple is like, I need earthquake insurance.
I don't know.
That's funny. Definitely let faith make some decisions for you. There's some emotions involved in it for sure.
Well, it is expensive, the earthquake stuff. So I haven't pulled the trigger on it yet. I know you sent me a quote or two on that.
Yeah, that's fine. I have a lot of people and that's fine, right? Like I don't expect someone to just buy everything I send them. It's a resource, right? Like I actually have people that live in Idaho and Arizona. I'm not licensed in either of those states that will send me their policies just to review. I usually only do that for they're like childhood friends and whatnot, but I'm willing to do that for other people because I recognize if I have someone in Idaho that I'm reviewing their policy and helping them, okay, when their family is in Idaho, when their family is in Utah, when they move to Utah, they say, I need an insurance agent. Oh, Jacob's the guy that helps me.
Yeah.
Right. So that's part of my, I'm getting too excited. I'm being really loud, but yeah, that's the whole goal of it all. But anyways, thanks, Sam. I'm excited to have you on.
Yeah.
Sam Jones, financial planner. He's my financial planner.
Yeah.
It's great. It's exciting.
Yeah.
How did you end up, getting, I don't even know where to start just talking, but how do you end up into financial planning?
Yeah. So my story starts, when I served a mission, right, for the Church of Jesus Christ of Latter-day Saints. And on my mission, you're obviously teaching people about Jesus and the gospel and helping people build their faith. Yeah. But, for me, it was like, okay, I'm helping people improve their lives and make progress and feel better. And that being able to help people really had a big impact on me. And so I was like, okay, once my mission was over, I was like, bummed, amazing 2 years, but obviously I've got to move on with my life, go to college. And I got back, I did a job shadow with a neighbor, and he was telling me he was a financial planner, and he's like, this is literally the mission, but it's financial principles instead of gospel principles. So you get to teach people financial principles and help them improve their lives. And I was like, man, I'm sold. Let's go. So let's sign up. So went to UVU,
Yeah. We went to school together.
Yeah.
We both went to the financial planning program together. Yep. Sam's doing what I wanted to be doing.
And funny enough, Jacob was the Money Management Resource Center president when I was there. He got me involved in the Money Management Resource Center, and then I ended up taking it over when Jacob graduated. So as the president, I served for a year or two and then passed it on to another guy.
Yeah. And the Money Management, it's a counseling center at UVU that's free to the public. My understanding, it's still free to the public to just get, help with budgeting and debt management and stuff like that. So it was super cool.
So anyways, went to UVU, got involved there, did a bunch of internships, whatnot. And then jumped into, when I graduated, I wasn't married at that time. So I was like, hey, now would be a really good time to start building my own book of business, my own business, if you will. Probably the best time ever because I have so little expenses. And I know from talking to friends and things that had already had started a family, once you get kids, it's
way harder when you've got a mortgage and 3 children.
Yeah.
I know my dad actually, he decided he wanted to be a chef.
Yeah.
After he finished his business degree, he worked for Home Depot and Toys R Us and managed stuff like that for a long time. That's actually how we moved to Utah. But he wanted to change and wait, I want to go to school to be a chef. And my mom was like, you've got 2.5 children. She was pregnant with me at the time. It's you got to get to work, It's way easier when you're younger. Yeah, absolutely.
Especially, cause I wasn't married, very little expenses. It was like COVID right when I graduated. So like I moved back home for a little bit. And so, just jumped in. I was like, I found a good firm, Vitality Capital Management. The owner there, Matt Romney, we connected, and it's an independent registered investment advisory firm, which basically means like we're not beholden to any one company, kind of similar to what you do with insurance, right? But we can shop the market and do what's in the client's best interest.
Yeah. You guys do investment management, financial planning where you're reviewing financial scenarios.
Yep. And we're fee only, so we don't get like commissions or kickbacks.
Yep.
But yeah, so that was the setup. And to be honest, like when I started, like they gave me like a little stipend, like I think it was like $1,000 a month. Yeah. And then I like, go build your book.
Go do it.
And I did there was a tax CPA there. So I did tax prep with her like the first 3 years, which was actually like super helpful looking back. Cause
it was helpful to me. Your tax knowledge was what blew me away.
Yeah. And I feel like that's a big piece of what I do, but, so I did taxes with her, kind of made it work from an income standpoint until I could start building, my business. I got really involved with the Salt Lake Real Estate Investor Association, and decided I really wanted to help. I felt like real estate investors and business owners as well, but like especially real estate investors were underserved.
Yeah.
Just because the way that the financial services industry gets paid is often by managing assets or collecting commissions on products, and real estate investors are buying real estate. Like there's not really a whole lot of crossover.
Yeah. Towards
like, hey, like as a financial planner, I can help you because the way I get compensated doesn't align with the way that you're investing.
Yeah.
And building wealth. So instead we just decided to
try to get the mic a little bit closer to you. I know that he likes it to be like 6 to 8 inches away. Just throwing that out there. I just know that it'll make the audio better. Anyways, keep going.
Cool. So anyways, getting into, working with real estate investors and business owners, the main thing was that, I had to figure out a service model that would help both me, like compensate me for helping them, but then also I could help them and be impartial. And so we just came up with like, we do a small assets under management fee for any assets we manage. But then on top of that, we just do an annual ongoing planning fee.
Yeah.
And it really has worked well because like at the end of the day, it's not about like just your investment accounts growing. It's about like your overall net worth.
Yeah.
And your life really growing.
Yeah. So. It's funny because, everyone has such different philosophies on how they want to invest and how they want to, right? Like, and it's funny because, right, I've had another realtor in here who I respect and admire a lot. And he's like, oh yeah, like 40, 60% of my money is in real estate, right? Which for some people that's a lot, right? Like my assets that I'm trying to grow for retirement, it works for him and he's fine with that. And he's comfortable with that risk. And he we talked about a bunch of the risk in that.
Totally.
And there's nothing wrong with that, right? And if you want to do that, there's professionals that are able to help you with that. Where some financial professionals would be like, oh, you need to divest out of real estate. Yeah, you should only have 8 to 10% of your portfolio should be that. You need to, have 60, 70% of that in stocks and bonds and blah, blah, blah. And there's nothing wrong with that advice too. But for a professional that is willing to take on that risk and is more active in it, it's like, why not?
Yeah.
Yeah. That's cool.
Totally. So anyways, I bought a couple investment properties as well and am an investor myself, but love helping real estate investors and business owners. Like it's kind of both. And I think a lot of it's intertwined. Like a lot of investors are also business owners. And I have some clients that just like are more like contractors or like, but they kind of want to start getting into the investing realm of owning some homes and investment properties. So yeah. It's kind of what my practice or business looks like.
Yeah. Well, I just off the top of my head, I was thinking about when we were talking about my situation and right. I mean, obviously this is from a tax perspective, but we discovered that I wasn't properly depreciating my real estate and I was leaving like thousands of dollars of write-offs that I was able to use on my tax. Like, I don't remember how much it was. It was like $4,000 or $5,000 of taxes that saved me just by properly depreciating what I hadn't done before. And I'm like, oh my gosh, maybe I need a new accountant. Right. But I don't know.
So, and here's the crazy thing that I'll throw out there. Like you'd be shocked at how often I look at people's returns and like the accountant has missed something or like, and I think like I don't blame accountants because they're working with like 2,000 households.
Yeah.
Like
or
so many
3,000
people.
or 4,000.
Yeah. It's like, how do they keep it all straight?
They don't sleep from November until April.
It's all in one time of the year, basically. And so it's like crazy for them. And so I don't blame them for not getting it all right. And I think like either you got to understand taxes enough to like check their work or like hire a professional to do it. And that's kind of where I come in. I check all my clients' returns before they file them and catch mistakes all the time. And again, like I said, I don't blame the accountants, but like I've saved like even last year I work, this is an accountant I work with that I like.
Yeah.
And he missed something and it was like, he just forgot to like check a box on the tax return and like he sent it back and it was like $10,000 less that she owed in taxes.
Wow.
And it was like, wow. So
yeah,
little things.
They make mistakes, and that's why it's good to get good eyes on it. You know, have a really good team, and especially as you have more assets, as you add more real estate, as your income goes higher.
Yeah,
that's the time where it's like you need to work professional. I always tell anyone, I'm like, if you are making more than $100,000 and you do not have a financial professional, you are missing something that's going to be significant on your taxes,
sure.
right? I mean, obviously, even more so the higher your income, but like. That is like the bare, and even at lower, you can benefit from it. But like, that's if you don't, there is something made. At least that's what I say. I don't know what you say.
No, totally. And like one thing too, like we're in Utah, right? Yeah. A lot of people donate, right?
Yes. Charitable
contributions and things. I see it all the time where people are donating tithing or even to like other charitable donations where because tax laws changed in 2018, where you get a higher standard deduction. And now like, because of that, a lot of people aren't getting the charitable benefit that they otherwise were getting in the past or could be getting with their donations. And so like, that's a really big one, especially for people that do donate. Like, man, you have this golden opportunity where you're given 10% in tithing or whatever it might be. And there's some huge tax benefits, but we just need to like time it.
We were talking specifically for me, and I'm fine to talk about my own stuff, but like for me, the plan was, I was waiting this year to do my donations, and I'm saving that all aside. And then in January, I'm going to do, so that way I'm not doing any this year, at least visually, right? I've set the money aside to do it, but then in January I'll do it. And then that way I'll do double the amount of charitable donations for 2026.
Yes.
And that way I can take advantage of the higher standard deduction, which might be applicable this year. And then next year I can use an itemized, right? If I'm between the cusps of those two or something like that. And then, and then you also brought up donating my stocks, and then taking that cash and reinvesting it, because then I'm getting a higher basis. Like crazy things where it's like, I would never have thought of that on myself, and I don't have the timing for it and all that. And FYI, I do need to get you back on retainer. I need to get you on retainer rather than just doing it anyway. So we'll talk about this afterwards.
Let me add two things to this, because I think it's important.
Yes.
One for you. So the new, what is it? One Big Beautiful Bill Act.
Yeah.
Changed some things with charitable. So this is applicable to you. Starting next year, there's like the first 0.5% of your AGI, which stands for adjusted gross income, is not deductible for charitable. So like, let's just say you make $100,000. I think it'd be $500. Your first $500 is not deductible.
So it's even more important to double up.
So yeah, it's even, like, especially this year for you, like I'm saying, you might want to,
I might need to do it this year.
Might want to pay pay this year and then prepay next year's.
Oh, if I can.
Because of that, you can kind of look at it and see. But
we should talk after this and definitely have like a one-on-one meeting. And do that.
We can. But the other thing too is like next year, there's a new below the line deduction with charitable. It runs from 25 to 28, I think. But like there's an automatic $2,000 cash donation that like doesn't count towards the standard or itemized. The standard deduction. So next year, if you take the standard deduction, you could still get $2,000 of charitable on top of that. That's not counted towards the itemized bucket.
Terrifying.
Anyways.
But that's why it's important to have even more reason to have a professional, because it changes and I'm not keeping track of any of that, right? It's even more so because, right, when I tell people you don't need to keep track of the little insurance things, that's your agent.
Yeah.
I'm not going to keep track. I'm like, oh my gosh.
Yeah. And just to add to back.
Yeah, you said there was a second thing.
The second thing. So when you talked about donating stock, like I have a client right now who like he was super blessed, has an awesome family, but like his grandpa created an investment account for him and like has all these stocks that he bought in like the early 2000s and the late 90s.
Oh, wow.
That are like gone up a ton in value, right? Like he bought them, let's just say like $30 a share, and now they're worth like $500 a share. So like ton of growth. And I don't know, those I'm just making up numbers, but like if he were to sell, he would have a huge capital gains that he would have to pay. Right?
The difference between
but he donates, right? So we're able to take systematically every year, take his donation that he would have paid in cash and donate it directly to the church or to the charity, and then turn around and buy back that stock or probably other stocks in his case.
Yeah. With his cash that he would have donated for a higher basis.
And then he gets out of capital gains that he would have been paying it when he wanted to buy his house or whatever else, you know, when he sold, and it saved it. It's literally saved him tens of thousands of dollars over the years.
And that's the point so one of my people that I follow and I really like what he says, his name is Akbar Sheikh, and he always says, get more, give more. And people are like, oh, you're avoiding taxes and blah, blah, this way. I'm like, no, the point of this is I'm doing this because then I can even give more.
Yeah.
Right. Like I'm able to do more good by doing it. And it's there. Like there's a legal reason they made that hole. So it's not even a loophole, right? Like this is the intended plan.
Right. Taxes are meant, I think, in a lot of times to like benefit society. Like, like put money in a retirement account so that like you have money in retirement and the government doesn't have to.
And the government doesn't have to pay for you.
Exactly. Or like, you know, have kids and, you know,
there's a tax credit for it.
Yeah, exactly. So the same thing with charity, like charities are there to do good for people. And so they're going to benefit you for that. Yeah.
I love Charity Water. They're one of the charities that I donate to relatively frequently. And I'm like, yeah, it's good. It's good to have charities you like and charities you're involved in. And I need to do better about like donating some time. Like I want to spend time, and that's sometimes harder to find, but anyways, that's a different discussion. Because I love that thought of giving more and getting more and taking advantage of taxes and financial planning. But
I mean, hey, like this is donating time in a way, right? Like this is free, right?
It's true. Absolutely. Audience, free for anyone to listen to.
In a way
and get doing tax advice and real estate advice and all that, insurance advice on their homes. And I've been talking a lot about buried utility lines and water sewage line coverage recently because so many people don't have it. It's such a common home claim. And I'm like, it's easy to add $10,000 or $25,000. Yeah, it might cost $100 or $150 a year, but like, commonly missed coverages or tax loopholes or things like get a professional in your corner. They'll help. So
actually I have some questions related to insurance that like I wanted to ask you.
Fire.
I thought that it would just be helpful to ask you over the air rather than privately. Then other people could learn. But like, what do you see is like the most common denied claims? Like why would a claim get denied?
That's a great question. Are we talking like auto or home or both? Or
like, okay, let's just say like someone has a rental property or like someone got in a car accident. So like both of those. Yeah.
So as far as rental properties, the number one and number two most common reasons I see claims denied. One is having the wrong type of policy.
Okay.
So if you are a homeowner, there's two types of policies you can have for your typical. You can have an owner occupied policy. They're often called HO policies. There are some companies that write HO policies for non-owner occupied, but the general rule is you're going to use an owner occupied policy, and that's standardly called an HO3. For a condo or townhome, it's an HO6 because that means you're a unit owner in a building owned by a master association. So HO3 or HO6. There are some HO5s, but that's beside the point. So having that type of policy, owner occupied policies.
If you're living in the home.
Well, once it's an investment property, you should have a dwelling fire policy. So not an HO, a DP policy. If you have the wrong type of policy, right, it's like, hey, you're not living in this property and you can get your claim denied for it.
Yeah.
There are times I've seen insurance companies be charitable and not like do it and then say you need to switch it, but they have every right to deny a claim. In fact, I had an interesting claim. Here's another one before I get to the second one. So I suppose the third one. Is not having it in the right name. So if an LLC, like let's say you build an LLC that owns a property, they either need to be listed as an additional insured.
The LLC or the person?
The LLC.
Okay.
Or depending on how it goes, it depends on the carrier. You have to know the carriers because some carriers like Safeco or Liberty Mutual, they're okay if the LLC owns a property. They just need to be listed as insured. And then you, as the owner of the LLC, right, the control, need to be the named insured. There are some companies, though, that will require you to do the insurance in the name of the LLC. And then you be the human named insured, right, the point of contact. So it varies from carrier to carrier, but making sure if there is an entity that co-owns the property, like an LLC, they're listed properly. So those are two really common reasons claims denied. Wrong type of policy. not having the correct ownership listed. And the example I have of that, we had a situation, it wasn't our policy. I think they were with State Farm or Farm Bureau. Like, it doesn't matter what carrier it is. Any carrier would have denied this claim.
Yeah.
His mom passed away in like 1998. This was like last year that this happened.
I knew she
He never wrote new insurance. He kept the policy with her on it, and it was an owner occupied policy. Oof. Right. And yeah, so it got really messy. And at the end of the day, they didn't pay out for the claim. It was like a fire damage. I think it was a partial loss. It wasn't a total loss, but yeah, he'd paid on it for like 24, 25 years since his mom passed away, never wrote the insurance. And it's like, how on earth did the agent never try to talk to the lady in 25 years? You know, like how on earth, how did the kid not think to ask about it, you know, and just keep on paying? Like, something must have gone wrong. But either way, yeah, making sure the right person is really important, especially to there are some note. Like, we had a situation the last year, a lady got hit while driving, and the home stayed in her name. And you know, they hadn't finished going through probate and all of that, right? There's a process for transferring. And there was a claim that occurred, even though she had deceased, the insurance obviously paid for that claim. So the general rule of thumb is when there's a change in ownership, if it's staying within the family, like that sort of thing, like a husband selling to his daughter or whatever, like parents, or someone dies, you should try to do it by the expiration of that policy term. So if it expires in 6 months or in a year, that's generally the guideline. Try to do it reasonably then.
Okay.
But after probate settled, some people like call me and they're like, hey, probate hasn't settled yet. I'm like, that's fine. Leave it as it is. Insurance will not have a problem. Or I'll go to my underwriter and ask, hey, here's what's going on. What's the time frame you guys expect? And then we've figured out, we've got an answer. They're aware of what's going on. So just giving awareness to the insurance carriers is going to help. Third most common reason a claim is denied is occupancy status. So a lot of people do not know this. If your home is occupied, that's what that dwelling fire is for. Dwelling fire, occupied rental. If it's being used as a short-term rental, you might need to write it as a different type of policy, because most carriers write it on the basis they're assuming you have at least a 6-month or a 12-month lease with the tenants.
Interesting.
So it's the same tenant for at least that period of time, which is why a lot of landlords require you to sign 12-month leases. Is usually it's because their insurance requires it.
Interesting.
And they're fine if you go month to month after it, but right, if you sign a new tenant, they want that lease in there. So it varies 6 months to 12 months for the carrier. But if it's going to be vacant, a lot of insurance carriers will specifically say, if this property has been vacant for more than 60 days or 30 days or 45 days or whatever, it's not covered. You need a special type of policy that says vacant, a dwelling fire vacant policy, specifically for vacants. So it's really common for people that do house flipping or that are buying spec homes that aren't going to be occupied to do it. And with flipping, if you're going to be doing renovations too, that are more than just painting and carpeting, like, hey, we're remodeling a bathroom, we're replacing the roof, we're adding square footage or whatever it is.
Totally.
You need a renovation policy or a builder's risk policy. And those people hate to get them because they're very expensive. Like the last time I did one for someone, I got them a quote. It was like $1,400. And then they're like, oh, actually, I'm flipping it. It's going to be vacant. It's going to take me 6 months to remodel kitchen, removing a staircase. Like it was it ended up being like $6,000, $7,000. Wow. And those policies are usually considered fully earned premium. So even we'll write a 6-month policy or a 9-month policy instead of your normal year. And if they finish it quicker, you're not getting any of that money back. Like it is fully earned from day one. And if you need to extend it because you take that's its whole bucket. So but it gets messy. Get it clear. But those are the 3 most common reasons that people get their home insurance claims denied is, especially as a landlord, is wrong type of policy, wrong type of ownership, or vacancy that needs to be covered.
I've heard on with renters, you as a landlord, you should require renters insurance.
Yes.
And then have them add the landlord as an additional insurance.
Yes. So I've done that with my properties. So both of my tenants at the 2 properties I own, their renters insurance has me listed as an additional insured. Sometimes they want to list you as an additional interest because technically you aren't an insured. It varies from company to company. Some just use additional interest or additional insured for everything. Some really want you to be specific. Right. And some will ask, who is this? It's the landlord. Okay. It's just a notification notice. Right. So I'm not an insured, but I'm an additional notice. So if the policy gets canceled or if it's pending cancel because they don't pay it or whatever, I get notifications. And it's really important to do that. Same for business owners. I was talking with a barber who he owns 3 barber shops and there's 8 barbers he works, but they're 1099 contractors. They work their own hours. They work whenever they want. And he's like, how do I get proof of insurance? I'm like, just have them all list you as an additional insured, and then you'll get notices for each one of them.
Okay.
And so that's the way to do it is list that. And tell your insurance agent if you do that, because some insurance carriers, it's usually not a lot, but some give you discounts if you require renter's insurance. Some will give you discount if you do skip checks, vacancy checks, like eviction checks.
Oh, really?
Yeah. Some if you use a property management company, you can get a discount. Some companies do a 2% discount or a 5% discount, or some require it. Like if you live more than 100 miles away from your rental property, they require you to have a property management company to be eligible for a policy. Yeah. So touch base with your agent about those things, because you never know. Yeah. Some carriers don't give any discounts. It's just
this is why you got to talk to Jacob.
That's why you have to have an agent, because
and not just any agent, an agent that's actually engaged, right? That like checks up with you, and like, because that's what I found. Like I know enough about insurance to like say, like, look at someone's policy and be like, hey, like this looks okay or it doesn't, but like the nitty gritty things of like, it's just nice to be able to be like, hey, go talk to Jacob, and like he'll get you squared away. And
it varies by your situation too, because what if a carrier that gives a good price doesn't care about any of that stuff?
Yeah.
Right. Like, or if you get an LLC, sometimes if you put your business or if you put it in an LLC, it's a business, and some insurance carriers won't insure you. So before you do that, ask your agent.
Let me ask you on that though, because I have a question. Because like I've heard, obviously, estate planners say you need an LLC for every rental property, and then like I've heard other people that are like, hey, like just get really good liability insurance, and you probably are good until you have the house really paid down as far as like equity is concerned. Yeah. Do you have a thought or opinion with that?
So the only thing I know on the whole LLC, I'm not a legal professional. I don't know. I don't have a good enough understanding to confidently be like, oh, an LLC is absolutely going to protect you better than just having it in your name. I don't know all the details on that. I do know that generally speaking, if you're going to do an LLC property, it's going to limit the options that you can insure with, because so many insurance companies view that as a commercial risk, and it's no longer a personal insurance. It's commercial insurance.
The insurance gets worse.
And it's usually more expensive.
Interesting.
It's not like your coverage is different, or it limits the carriers. Like some carriers, they're fine with you doing it both ways. They understand. Some carriers are like, nope, if there's an LLC, we don't even want to touch it with a 10-foot pole.
Interesting.
Stay away from us. Go get someone else. So it can make your insurance more expensive.
But you don't necessarily have an opinion on that.
But I don't have an opinion, because either way I can do a $500,000 liability, right? Either way I can do
what do you find is like the optimal like liability? Because I'm like on like the more conservative side, where I'm like, hey, like go get an umbrella policy if like your net worth is like a couple $1 million or whatever. Like, what's your thoughts on like, when do you need an umbrella, or like how much liability is enough?
Yeah. So we had one umbrella claim in the history of our agency, and it was a 16-year-old girl, brand new license, ran a red light and was speeding. People were killed in the incident.
Oh, that's horrible.
Yes. Terrible situation. The family business owners, they owned their home mortgage free.
Yeah.
So there was a lot of liability exposure.
Did they have a lot of liability insurance?
It was like $1.2 million total at the end of the day. And they had an umbrella policy.
Of the payout, or
the ultimate net payout.
What was the umbrella policy? $3 million policy?
It was a $1 million umbrella.
Oh, so they had to come out of pocket.
So they did not, because your auto insurance is, the umbrella is on top of it.
Yeah.
So their policy was $250,000 medical per person, $500,000 max, and then $100,000 property damage. Obviously, repairing the car was less than $100,000. It was like a minivan, right? Utah minivan. Lots of people in the car, lots of medical billing. So it paid out the $500,000 medical, and then there was like an extra $750 that came from the umbrella. So a lot of people, that's the other thing people forget about that with umbrellas, is like, oh, I only have $1 million coverage. Actually, you've got like $1.6 million of coverage, because you've got $500,000 medical on your auto policy, $100,000 property damage, and an excess flat $1 million for any of that.
So at what point do you tell people, hey, like, you should consider an umbrella, or bumping up the liability from 300 to 500, or like whatever?
Yeah. Anytime anyone has teenage drivers, that's one of my things that I signal, at least consider an umbrella. In fact, I actually had,
and probably at that point when you have teenagers.
Scott Childs from UVU.
Yeah,
he was the counselor for a while, and now he graduated in PFB. I was talking with him. He came into my office the other day, and we were talking, and I'm like, you've got one, soon to be two teenage drivers. I told him that story about the car accident. I'm like, just ask, right? If it's like $400 a year to get $1 million umbrella, that's like almost a no-brainer to cover you for that much liability. Yeah. If it's $1,000, okay, maybe it's not, but at least ask the question, get the numbers, and then you can decide if it's worth assessing that risk. But so teenage drivers are obviously one. The other two factors, if you're mortgage free on a property, that's an absolute liability, because lawyers have ways that they can find out if you have a mortgage or not on your property. And if they say you don't, and your dog bit someone, you know they're going to go for $300,000. You know they're going to go for $500,000, right? They're going to go for the emotional suffering and pain. All that actually happened to one of my neighbors growing up. Their little tiny dog tied to a tree. The neighbor kid walked in their yard through a fence. I don't know how it didn't get thrown out, because it's like they obviously were not invited onto the property. The dog was tied to a tree and she approached, and the dog bit her, and they got like $150,000 out of that claim. I'm like, you got to be kidding me. Became bad neighbors, obviously. I think they ended up moving, the neighbor that claimed that. Like, it was insane. It's like, that was 15 years ago, 20 years ago. So my memory is a little bit foggy, but I insure the lady, so she told me about it, but it was a while ago. So I might not be perfectly accurate on the details, but that general concept is what happened. And you're like, right. So you never know what silly, stupid thing's going to happen and not go your way. So if you're a homeowner, especially if you're mortgage free, and then business owners, I'm like, if you own a business, it's like, even from day one, at least get $1 million liability. And you can get that for your business, but personally, just in case if something weird falls back on you. Do
you write business stuff or just personal at this point?
I do some commercial stuff. I do refer a lot of it to my friend Scott. He's great. He's a commercial agent only. Like, he only does commercial stuff. He's in Pleasant Grove. I send a lot of referrals his way. I've got another referral partner, Kraken Insurance, down in Southern Utah, and they're great too. So I have some things I can do. I do a lot of workers' comp insurance.
And if with business owners, it's more just like, hey, like, cover like the liability if something goes wrong type of thing.
Because you never know. Like, here's a weird situation, right? We had a business owner who he let one of his employees on a job site just quickly drive his car down to go get drinks at the gas station, gets in a car accident, and suddenly that's falling back as a commercial liability on his business because he let an employee drive his car, even though it wasn't the employee car, it was his own personal vehicle, right? Like, technically he's driving in a commercial sense, he's driving for something business related, even though it's something as silly as getting drinks from the gas station. It's like, he should have done it himself, because now it's like, okay, that's obviously not work related. If you're going to get drinks at the gas station, like, it's clearly delineated. So it's weird how weird liability things can crop up.
Yeah.
And that also was weird because, well, what if his personal insurance denied it because you're now using your personal auto in a commercial? So his personal auto did end up covering that. But it's just like really weird to think about. So it's like, you never know what weird thing might end up falling back on you. So especially if you're client facing in person, not virtual, but even virtual, right? There's advertising risk and things. It's just not a bad idea to get it, or at least consider it.
What type of business insurance do you say, hey, like, these are the ones you should look at?
Yeah. I mean, obviously there's your general liability. Yeah. There's your professional liability or errors and omissions. So as an insurance agent, for me, it's very important to have. Yep. Another insurance agent I know, they actually had a dispute with Progressive because they didn't get a physically signed form. The client decided they didn't want uninsured motorist protection, which is just a standard. I'm like, why get rid of it? That was like $6 a year. Like, why would you get rid of that? Yeah. He got in an accident. That other driver hit him, right? Not at fault. He had medical bills. So Progressive said, we need a copy of that signed form that you got that says I am rejecting that uninsured motorist protection. They didn't get it signed. So suddenly Progressive saying, we're not covering this, but so the client ended up making a claim. And so their errors and omission insurance paid off $50,000 for the medical bills. And if you get a lot of professional liability claims, right? So like if you're a chiropractor, what if you break someone's neck on accident, right? If you're a dentist, what if you drop a tool in the back of their throat and you can't get it out and it causes permanent damage to their airways, right? Yeah. Like, so professional liability or errors and omission, super, super important professionals to have. Okay. I would imagine the company you work for,
I know errors and omission. I know we have it.
Yeah, for millions, because right, especially like, what if you click the wrong button and you accidentally sell a bunch of stuff and you don't do it I don't know, and there's a tax liability that's created because of some, like, you never know. So professional liability is super important, and some people don't get that. They only get normal liability coverage. General liability and professional liability are different. Oftentimes they're bundled together, but I've seen people that only have general liability, and it's like, okay, well, if you're a barber and you've only got general liability, that's going to cover someone's slips on your mopped floor or something weird like that. But what if you cut someone's ear off with your barber? Now, that's going to happen, but right. It's like, yeah. So professional and general liability are the two most important ones. Obviously, if you have employees, workers' comp, and then there's weird things you can add onto that, like cyber risk, right? Like if you store clients' data and you get hacked, that's a special coverage you add on top of it. So those are the two most important ones.
Cool.
For sure. Definitely get that. Yeah.
Well,
thanks for asking me so many questions.
Yeah, no, I mean, I had those questions that like, I've always I mean, you know, as a financial planner, you have to be pretty versatile across a lot of different domains. And so I feel like insurance is helpful for me too. But anyway.
Yeah, I want to get to you. We've talked enough about me. I want to talk about the value of client. Obviously, we talked about like some of the tax stuff and some of that, but what's the general, I don't know, wherever you want to take this, like what does it look like working with you? What is it like to, like, most people have never worked with a financial planner.
Yeah.
They've worked with their tax person.
Yeah.
They've worked with a bookkeeper maybe, but
Yeah.
what, obviously we've demonstrated some of the value, right? You look at some of the tax stuff that people might miss and charitable contributions and investment management, but yeah, what does it look like working with Sam Jones?
Yeah. So, I mean, high level, like we take people through an upfront financial plan, and then we do like a really deep dive on like, you know, all the CFP topics. I'm a certified financial planner. I think you are too, right, Jacob?
I'm not technically. I passed.
I passed the exam
and then I never
part.
got the hours because I didn't go into it. I got into insurance, so it didn't count. So I am a former CFP candidate.
Anyway,
the best way to say it.
So, like, you know, we go through all those, but I think the biggest differentiator for me towards like other financial planners are like, we really focus on tax planning is a big one. We focus on like income. And then like, again, like I was telling you before, there's only so much you can do from an income standpoint as a financial planner, but there's certainly some things you can do to move the needle. And like, you know, they always talk about like the 80-20 rule. Like if all of your financial picture is bundled up into like a, you know, pie chart, I would say like it would be really beneficial for you to spend 80% of your time focusing on how to increase your income. Because once you do that, like you can just hire professionals and like systematize things, which is a big part of what we take people through in our financial planning process is systematizing things. In the book, Atomic Habits, he says, we don't rise to the level of our goals. We fall to the level of our systems. So like we need good systems, but like we can systematize things to obviously really take care of most things.
Yeah. Well, true. Like, and then I implemented one of the things we talked about instantly, and it was so much easier. Each of my investment properties has its own bank account. Why didn't I do that years ago? I talked to you and I immediately did. I'm like, oh my gosh. So all the cash flow in and out, all the utility bills, all of my taxes. And then at the end of the year, I don't have to go and figure out which of these bills are associated with the property. It's like, they're already in there. So much super easy. All the rent going in, all the mortgage payments going out. So it's like, systematize it, make it easier.
Yeah. So yeah, but big picture, you know, like if you can focus 80% of your time on like, okay, how do I increase my income? And what, like, it's not just like working more hours or like working harder, right? Like, it's like, how do I, cause like we could all do that. And I think like leverage, right? But like, I think like, you know, if you're working towards like a short-term goal, I think like say getting out of debt in the next year, like, okay, working more hours can be very doable and like a good strategy, but like, it's not like a 30-year plan. No. You know, we don't want to like not have a family life and like not be able to like enjoy our hobbies and have our faith and everything else. So like, you know, how do we increase our skill set? How do we get paid more per hour? How do we, you know, bring on bigger clients, or like, how do you sell more? Like whatever, you know, industry you're in. And you know, even if you're in like more of a W-2 job, like how do I transition to another job that would pay me more? How do I go to my boss and like talk to them about how I could get paid more? Yeah. You know, how
like,
can I add more value to the company? So
yeah, exactly. You can pay me
more.
How do I add more value so I'm worth more? Yeah. On the systematizing stuff, right? Like that's something I'm jumping into recently. Like I'm leveraging a podcast studio. I'm paying people to create shorts and edit and do my content. It's like, that's leverage.
And I think,
go for it. Sorry. You're good. We're both excited.
No, I was just going to say, like, I think obviously like we met and like part of your financial plan, like was like, hey, like if you can continue to increase your income, like all these things are going to get easier and you're going to be able to like achieve all your financial goals. But like, I think it's super cool that like you actually are implementing it. Like you went and started a podcast, and now like, hopefully like it will result in like, you know, you increasing your income, your business and everything else. And then, so like props to you.
Yeah. Thanks.
But yeah, I mean, big picture, like that's what I would say to people is like, let's focus on those things and like hire me to take care of all the little things. And just to share like an example, like I have a client, we'll call him Bob. It's not really his name, but Bob, he comes to me and he's like, he's handling everything in his finances, his mom's finances, his sister's finances. And like, he's kind of got a little bit of a complex situation. So there's a lot going on. Yeah. And so like, instead, like I sit down with him and like, I help him like systematize his bookkeeping and systematize, his cash flow, his investments, his tax planning, like all those things. Like I essentially took it off his plate. So now like he was freed up to like go and focus on his income. And like, he's an extreme scenario, but he literally doubled his income in 2 years.
Yeah.
like crazy.
Yeah.
But like,
spend your time doing the 20% stuff that moves the needle and systematize or pay someone. People get so scared to pay someone to do something for them. And it's like, well, wait a second. If I spend $40,000 a year, $50,000 a year on an employee that's going to do this and this and this and this and this for me, I can now spend all of my time getting more clients, or this person's going to do quotes for me, or this person's going to do all the servicing for me. Right. That's how I was when I first started my office. I was the first guy that my boss hired to systematize. And now there's 7 employees. And guess what? He comes to work like 10, 15 hours a week. He's on podcasts and he networks and markets and stuff when he's not there. But because he's doing all those things for those people. Yeah. Right. And he's paying people, he's able to 10x his income. You know?
So cause I was curious, I was like, okay, like what if someone is making $80,000, which is kind of like the average here in Utah,
about 80.
Over the next, let's just say you increase 20% every year for the next 10 years. Like, what would that do to your income? At the end of 10 years, you'd be making $495,000 from 80, right?
Yeah.
So like, this is applicable. Yeah. I mean, even 10%, but like, I think we get caught up in like, how do I get this perfect portfolio? How do I increase my investments by like 10% or 3% or whatever it might be? And those things matter, but like, man, if you can make $495,000 a year, 500 grand, like, now you can take that dream vacation. Now you can fund the kids' education. Now you can, retire by 50 instead of 75 or whatever.
Yeah, 75. True. That's
like
the norm
everything
now.
gets easier. And and again, I don't want to say like, hey, we need to sacrifice like our personal life in doing this. Like you should still have hobbies. You should still like spend time with your family. And like those things are very important and like more important than your work, to be honest, in a lot of ways. But like, if we are very intentional about increasing our income, like you can have both.
Yeah. Yeah. And you need to leverage systems. You need to leverage professionals that are in your court.
Yep. Systems, teams, all the things. Yeah.
Because one thing I was reading about was, I'm going to call it decision fatigue, but I'm not sure the exact term that was used in the book, where it's like your mind only has the capability to make so many choices in a day. Yeah. And so if you have to think about what am I going to wear, so frequently, like, right. You get like is it Bill Gates? The Apple guy.
Mean, even like
Steve Jobs, right? Where he wears the black turtleneck sweater. Like I'm not saying that you need to get rid of your wardrobe, right? It's just the concept. The fewer decisions you make, what am I going to eat? Right? Like, oh my gosh, I get so frustrated when people ask me, what are you making for dinner tonight? And I'm like, I don't care. That's not important to me. Like, remember, I love food. I'm an overweight guy because I love food. But like that, I do not want to spend my decision-making focus on that right now. Totally. I'm going to make that decision on Sunday with my wife. We're going to plan what we're going to eat for the week. And then I'm not going to think about food again.
Yes.
Like systematizing and then spend your time on the things that move the needle. For me, podcasting, connecting with professionals. Yeah, that's going to get me more clients than sitting in my office waiting for the phone to ring and doing quotes. And which is wrong. I love doing quotes, but I can pay someone to do that.
Yeah. I mean, that's the easy the systematized part that you're talking about. But like, even beyond that, you were asking me like, what else is kind of involved? So like cash flow planning is a big part of it. I'll talk more about that in a sec. Like investments, obviously that's a big part of it. Retirement, estate planning, insurance, all the different things. But like, I think the other thing that I think maybe I do differently than a lot of financial planners is the cash flow side of things. And it comes back to these systems. Like most I won't say most, I'll say a lot of financial planners out there, like all they do is investments.
Yeah.
Or I should say investment managers, because they're really not financial planners. But so like for a financial planner to sit down and do a budget with you would maybe be big. Yeah. But there's certainly ones that will do that. But even beyond that, like how are we, like say you own rental properties, like, are we allocating money towards like CapEx? So like a new roof in 20 years and like a new water heater in like 6 and like, a new furnace in 4 and all the different things that you're going to need. Like we should set up a system where like, instead of, especially people that want to like live off their real estate and retire off real estate, like what are you going to do when you have to replace a $20,000 roof if you didn't plan for it? Yes, exactly. Yeah. So like cash flow, like setting up systems to first off knowing and tracking, but then like also, I mean, I listened to one of your podcasts, your first episode on the way in today to work, but you were saying, I can't remember who was the girl. Deveray. She was saying how credit card debt has gone through the roof. And honestly, I've seen that in like just the people that I've worked with. Like it really, like there are people that like just put it on the credit card and people are struggling. So like, I'm a big proponent of like using a debit card and like, That's probably different from what most people are going to tell you.
Because everyone talks to you about getting the points and getting the 2% cap. My wife and I love our 1% when you buy, 1% when you pay it off. You know, it's like, I'm getting 2% cash back, but you spend more.
No, you totally spend more. And like, it's so easy to just put it on the card. Cause like there's no accountability, right? And so like, I'm big about like, okay, let's map out what you want your cash flow to look like. Let's automatically start some savings. But then like, I think it's powerful to have different accounts. And so like, I say like, send some money to an account for like all your bills. And then like, that's just all automated, right? Like all your money goes in when you get paid or at the beginning of the month or whatever. And then like the money goes out throughout the month when those bills hit. But then like, let's get like all that, what I call ad hoc expenses, or like variable would be another word for that, expenses, and send it into an account specifically for like anything that's variable. So like groceries, eating out, movies, like those things that people can make a difference on and can really wreck your budget if you're not careful. Like put all that into a debit card. And there are debit cards, by the way, that do cash back, because I've gotten that pushback a bunch. Right?
Really? Okay,
yeah.
Cool.
They're not as good.
Yeah.
As like the 3% or whatever on like some credit cards, or 2%. They're normally like a 1% type of thing. But like the clarity that people get by like having, and me and my wife do this too, like the clarity you get by like every time you swipe, you see the balance go down. Instead of like guessing, or at the end of the month going and like tracking and like putting in a spreadsheet and like figuring out, did I overspend? Did I not overspend? And like, no one does that. But like, if you do that, it's like reaction.
Oh, my wife and I do.
Yeah.
We monthly look at our budget.
Okay. So like
and we actually pull all of our transactions from the credit cards, from my bank account.
So you're
from
a rare
Venmo,
example.
and but yeah, it's because, right. I did financial counseling at UVU for years.
You understand the importance of it.
And I understand the importance of it. And it's important to me. And we talked about it with my wife. And so that's important. We spend time doing that.
Yeah. So that, I mean,
but most people don't.
This is something that I've kind of developed more in the last like year, but like, I think it's super important to like have some clarity and accountability. And I think a debit card with like that bucket of money that goes in every paycheck, every month or whatever it might be, to just have, okay, this is what we have left to spend. Like this is our accountability. And then like as a financial planner, I don't have to keep them accountable. It's the debit card that's keeping them accountable. They're
naturally accountable.
But then I can, follow up with them and help them keep them accountable when we do meet. That's it's just, I think that cash flow is like huge, and like it can make you or break you in so many ways. And so having a system so that you can go focus on making more money and not worry about, am I overspending? Just check the bank account, easy, bam, done.
See, that's it made me think of my boss. My boss all the time tells me, like, I have no idea how much money I have. I don't care. I don't keep track. My wife.
This is not normal.
No, it's not normal. It's definitely not normal for a guy that that owns an entire financial. Like, there's a lot there, and he's like, I don't know. My wife just tells me what I can spend, and that's what I spend. If I'm like, hey, I want to be able to go buy lunch every day. That's what I'm going to do with my money. And she's like, okay, I'll make sure there's money on your card for that. Like, she handles all of the money. And he's just like, I just go to work and I sell policies and I make business decisions. But that's not normal.
Here's the thing. Imagine if both spouses are, because like that's pretty common. It's kind of normal for like one spouse to take more of a lead. Yeah. But like I've met with clients where it's like both spouses don't love the money. So at that point, it just totally
gets messy and
no one knows. And
systematizing it makes it so you don't have to worry about it. It's like, do I have the money here? I can spend it. If I don't, I can't.
Exactly.
That's cool.
So
that's cool. I know specifically with you're talking about like the CapEx for financial properties. We implemented that, right? That was part of the plan you implemented for us, was me realizing, oh, Jacob, you think you're cash flowing this much money.
Yeah.
But if you're saving for CapEx, you actually need to save all that money and add a little bit more money, because here's what it costs through. That was such a cool spread. Like that alone is worth going to Sam for, because it was like, oh, on your 200, it's like, this one's costing this much money. This is how much you're paying. This is your HOA. This is expected. Here's how much it's going to cost. Here's how frequently you need to replace your floors. Yeah. Oh, and I even brought up, it's like, oh, well, I think the floors will be long. Okay, cool. You just adjusted it from 8 years to 10 years. Okay. You still need to save this much.
Yeah.
So you can adjust those variables and then be like, okay, you need to make sure you're cash flowing at least this much to cover that. And if not, you need to be putting extra money into that property.
Yeah.
You're going to potentially have problems.
Yep. I think a lot of real estate investors oh yeah, I cash flow. It covers the mortgage. And you're like,
that doesn't cash flow.
That you got like maintenance costs, like the leaky sink or whatever. You got to call the plumber for, you got to go fix yourself. But then like CapEx so big, like that's the silent killer that like really screws a lot of investors.
Yeah, well, because I had to replace a washer or a dryer in one of the units, and I was like, oh, I mean, I already had money in the account for that.
Pull from
I had to I did tune-ups for all the HVACs for all 3 of my properties, including my personal one. I'm like, whoa, that was a little bit more than I thought it was going to be. But I shopped around and found good deals, and I ended up using a friend of mine. His company's great. You know, the garage door stopped working on one of my properties, and I had to get someone out to fix that. And I was like, oh, that should be like $100. Nope, there was like a thing weird, and I couldn't open and close my garage door, and it ended up costing me like $250. And it's just things pop up, so you have to plan for it. If you don't plan, like you said with Atomic Habits, you plan to fail if you fail to plan.
Yeah, exactly.
Well, that's not from Atomic Habits, but that's my version of it.
No, I mean, it's true. It's true.
Wow. See, because a lot of people think of financial planning, think a guy that wants to take my money and invest it, and that's it. And it's like, no, this is comprehensive finance. CFP, certified financial planners, are so much more than that. We're talking about taxes. You even did a life insurance analysis when you were like, here's how much life insurance you should probably have. And we ended up getting more life insurance for Kimberly after that. It was great. We only had like $250,000, and now we've got $1 million for her.
Yeah.
And replacing our old policy was actually pretty good anyways. And the cash flow management, you know, and I actually have a screenshot of that theoretical, like what we should be spending in a year in my budget that Kimberly and I review when we're spending. It's like, wait a second, we're out of alignment here. What's going on? Like, so it's super clarifying. Like I like talking about how people feel, because people are like, oh, this is just a bunch of, you know, like technical stuff. I'm like, no, this is about how you feel.
Yeah.
Right. Like, you're going to feel confident.
Yep.
You're going to feel that you know how to get to retirement.
Yeah.
You know, you have a plan for buying your next investment property if that's what you're saving for. You know, like we did a financial priority list. It's like, hey, priority 1 is paying off student loans. Priority 2 is this. We want to buy a new house, and we want to buy another rental property at this time period. And you're like, okay, well, here's what you have to do with your budget. And, you know, if you're thinking these things with your income, this is how you get there. So it's like, I know that in 2031, I'm going to be able to have these 5 things done.
Yeah. That's
so cool. That's empowering. It like makes me excited to wake up in the morning and go to work, you know? So.
No, I agree. And I think too, like, I mean, I do an upfront financial plan for people. I tell people, like, if this needs to be super, like, you need to be able to execute on this. Like, this is just a fancy piece of paper if, like, you can't execute and actually, like, improve your life. Right. But, like, even the minute the plan is done, like, in 10 minutes, things are going to change.
Things have changed.
Yeah. And, like,
I'm actually in the middle of selling one of the properties to buy 2 more.
Oh, nice.
That's going to do a 1031.
Oh, nice.
Very excited. Actually, another guest I had on the episode, on the other podcast, Parker, we were talking about during the episode, and after we talked, and he's like, Jacob, you've got enough equity. You can do this. It might cash flow a little bit less, so I'll have to CapEx more, but we need to talk about that too.
That's dope. Good for you.
Yeah. The one thing I realized, especially from our conversation today, is because with our initial plan, I just did the one-time plan, and that is not adequate. I'll let you talk about it more after I say this, but doing the one-time plan was not adequate. We need to get back on and do the retainer model that you talked about before, because I know I'm not executing on some of that stuff.
Yeah.
And having the quarterly meetings with you would make me do that. So I need to, especially when we're talking about the tax stuff that changed. And I'm like, that changed probably a month after we did our plan.
Yeah.
Yeah.
Yeah. Things are always changing. Right. And like
the big, beautiful bill.
But like at the end of the day, right. Like just like what you're saying, like having clarity, even though the plan's going to change and things are going to adjust and like nothing's going to go according to plan, because nothing ever does. Right. Like having a plan. Like, it's funny because I was talking to a different client of mine, and he does like 10 flips a year. So like he's finding amazing deals. And like for him, like he knows he wants to have, for him, it's like 10 paid off properties by like a certain age. And so like, yes, things are going to change. Yes, things are going to be messy in the middle and like whatnot. But like for him, just having that clarity of knowing, like, if I do these things and focus on like my income, like everything else will fall into place. Yeah. And so like just having, I guess that for him, that accountability partner and that person to help him navigate everything he's got going on. Cause some years are huge tax years and other years are small tax years, cause he maybe had some bad flips or whatever else. Like it's very impactful. And I think, I mean, just that what you're saying, like the feeling of like knowing you're making progress towards your goals is super important and powerful.
Absolutely. I agree. Perfect. I feel like we're kind of wrapping up. I don't want to.
I feel like we could talk for like.
We could. I try to keep it about an hour, and we're getting close to that.
This is great.
We could talk more. We definitely need to do another one of these, because it's great. Almost every single person I've had on, I've said that too. It's like, Man, we need to have you back on in 3 months and just talk again. But
I feel like you're easy to talk. Like you're a good host.
thanks. I appreciate it. I'm very bad about accepting compliments. So thank you for complimenting me and letting me handle it in the awkward way that I just did. Yeah. Thanks so much, Sam. It's been great having you on. Yeah, it's great. I love it. I love it heaps. But yeah, the one takeaway from this, if you're making money, if you're making over $100,000 a year and you don't have a professional, even if you're making 80,000, like getting someone in your court to just evaluate things is worth it. Sam's the guy for it. It's who I use. We're going to get on the retainer after this. Call me later today or tomorrow and let's get that sorted because I need to do it.
I would just add too, like, it's not just one professional, like having because I'm not an insurance expert and like, I'm not an estate planning expert, but like I have people and you should have people for like, when you need those things.
Yep. You need the estate planner, you need the financial planner, you need the insurance guy, you need the life insurance guy, you need the health insurance person.
Yep.
People that can evaluate the situation and help you make good decisions and be proactively engaged for you.
Exactly.
That's absolutely what you need.
Thanks, Jacob.
Perfect. Yeah. If someone's listening to this and they're like, I need to get a hold of Sam, how can people find you?
Yeah. So company vitalitycap.com.
Vitalitycap.com.
Yeah. Man, I should have been more prepared with this part.
You're good. You can send me stuff afterwards and I'll put it in the show notes and it'll be in like, YouTube links and all of that. So we can put Instagram or email or phone number or whatever you want me to put.
I can add my Facebook and you can like DM me or whatever.
Sweet. That'll be good. We'll add that in there for sure. Yeah. If you've liked this, leave a comment about something that you thought was interesting, something you thought was weird, questions you have for Sam or for me. We'll definitely have Sam back on again in the future. So if you leave a comment, ask a question, we'll be sure to ask it next time. Like, subscribe, follow, email me for an insurance quote, talk to Sam for financial planning advice. Yeah. Thanks for watching.
Thanks, Jacob. This was fun.